Welcome back to the program, everyone. Thank you so much for joining me. Thank you for being here. If you're new, please subscribe to my Substack and Patreon to get more and exclusive content. Just follow the links in the video description below to get connected. I would absolutely love to see you there. Well, I have bad news for you today that I would like to discuss. The latest report shows that U.S. employers announced 108,435 layoffs in January alone. This is an increase of 205% from December, from a month prior. This is the highest January total since 2009. So the United States labor market is quietly deteriorating. That's the truth, and there's no denying that. The numbers were revealed in a new report from Challenger, Gray, and Christmas showing that U.S.-based employers announced more than 108,000 job cuts in January alone. That is up sharply from about 35,000 in December. So compare 35,000 in December and then an increase of 108,000 layoffs in January. Year over year, compared to last January, of January 2025 that is, this is a staggering 118% increase. In fact, this was the highest number of job cuts announced in any January since 2009, right in the depth of the Great Recession. According to the report, most of these layoffs plans were set at the end of 2025. It actually means that companies entered 2026 already very pessimistic about growth, about consumer demand, and about profitability. Yes, layoffs often cluster in the first quarter. That's been the trend for many years, and that's normal, but this was not a normal January. What's different here, and what's very concerning, is that hiring intentions collapsed at the same time. Companies announced plans to hire just over 5,300 workers in January. Now, for the United States, that is nothing. This is the lowest number ever recorded for the month of January since Challenger began tracking this data in 2009. This is absolutely unprecedented. We need to take this seriously. When layoffs rise and when hiring plans dry up simultaneously, as we see now, this signals something deeper than routine corporate belt-tightening or just trying to cut costs. Nearly half of the announced job cuts came from just 3 companies. It came from Amazon, UPS, and Dow. Amazon plans to eliminate around 16,000 corporate roles as part of an internal restructuring. UPS announced as many as 30,000 cuts, which is largely tied to its gradual wind down of its delivery relationship with Amazon. Dow is cutting about 4,500 positions as it restructures operations in response to weaker demand and higher costs. Other companies actually followed suit too. Nike announced workforce reductions, Peloton trimmed staff again, and these are not startups, of course. These are large established firms that are forced to adjust to tougher environment. And if these firms are laying off thousands of employees, which doesn't look good on paper, it doesn't look good for their shareholders, what should we expect from smaller and mid-sized companies? The official reasons that are cited for the layoffs tell their own story, and that's something I would like to focus on next. Contract losses were the biggest driver, followed closely by broader economic conditions and restructuring. In other words, companies are seeing less demand, fewer reliable revenue streams, and they experience a significant amount of pressure to cut costs before conditions worsen. That's the truth. Now, as expected, artificial intelligence also showed up as a factor for these layoffs, with more than 7,600 job cuts attributed to AI-related efficiencies. While that number is smaller than some headlines may suggest, the direction is very clear. Executives are increasingly prioritizing automation and efficiency over hiring. Even when companies are not actively laying people off, they are choosing not to replace roles that can be automated or absorbed by smaller teams using new technology. And so that fits into a broader pattern that's been developing for over a year now, and I've been discussing it here on my channel for at least 12 months. We're seeing the so-called low hire, low fire labor market. Layoffs haven't exploded across the board, but hiring has slowed to a crawl. Job openings have steadily declined, and workers are finding fewer opportunities to move or to negotiate higher pay. New data from the Bureau of Labor Statistics reinforces this picture. At the end of December, job openings fell to about 6.5 million. This is the lowest level since September of 2020 during the pandemic downturn. Hiring rates, quit rates, and layoff rates all remained relatively steady, but at subdued levels. So what is the key takeaway here? Well, this is not a healthy expansionary labor market, of course. This is stagnation. And for job seekers, this is very, very painful. As economists point out, job openings are a forward-looking indicator. They reflect what employers plan to do in the future, not what they've already done. And so a decline in the openings signals hesitation, uncertainty, and a lack of confidence about the future. And uncertainty is everywhere right now. Economists have noted that sweeping policy shifts under the Trump administration, such as tariffs and immigration, those things have added another layer of uncertainty and unpredictability to the labor market. Companies are struggling to plan ahead, and instead of expanding payrolls, many are delaying decisions. They are effectively conserving cash and trying to experiment with automation and AI rather than committing to long-term hiring. That is terrible for job seekers. This helps, of course, explain why the so-called hiring recession doesn't appear close to ending anytime soon. Private sector job growth in January was very weak. According to ADP, companies added just 22,000 jobs last month. This was the worst January reading since the pandemic-related downturn in 2021. Nearly all of that growth came from healthcare, which continues to hire regardless of the broader cycle, but outside of healthcare, hiring was very, very slow. Initial jobless claims added another layer of concern here. First-time unemployment claims jumped to about 231,000 jobs at the end of January. This is an 8-week high. While that number isn't alarming on its own, the trend does matter. Claims have been hovering near 2-year lows, and this jump actually suggests that layoffs are starting to filter through to official data. So as you can see, this environment is very unsettling, and fewer job openings mean less bargaining power. Slower hiring means fewer opportunities to move up or to switch roles to negotiate better pay. Even if layoffs remain somewhat contained in the future, fear alone can change behavior. It changes consumer behavior. People tend to spend less, they try to save more if they can, and they certainly pull back on big purchases when they sense that there is risk in the job market, that they may lose their job. They're not going to spend. So in other words, consumer demand is likely to be impacted. It is likely to weaken even more. And so that feedback loop matters here because consumer spending drives the US economy. A fragile labor market, as we see right now, it is deteriorating. This doesn't need to collapse to slow growth. It just needs to make people nervous enough to pull back their spending habits. The Federal Reserve continues to argue that the unemployment rate is showing signs of stabilization. Now, it is fair to be very skeptical. Stabilization at a weaker level is not the same as strength. The labor market is cooling. It is collapsing. What makes this moment tricky is that it doesn't look like past downturns. There is no sudden spike in unemployment. There is no dramatic crash in hiring either, but instead, this is a grind. Fewer openings, fewer hires, more restructurings, more talk of efficiency, more pressure on workers to do more with less. And this is not a good scenario. This is a deteriorating labor market. And so it will be really interesting to see how far that weakness actually spreads within the next several months. Thank you very much for watching. I hope this quick video was interesting. If that's the case, please make sure that you support my work, like, subscribe, and share. And if you can, please become a paid subscriber on YouTube, Substack, or Patreon. I appreciate every single one of you who has become a paid subscriber. Thank you so much. Enjoy the rest of your day, and I will see you back here tomorrow. Bye for now.